What's up, guys? My name's on the desk. This is the Ventura County Real Estate Show. I found some slides, some data online, and I'm going to share some slides on some February real estate data. I'm going to do this monthly to share information that I find, so you can be up to date on what's going on in the real estate market. So let's get to it. Home ownership is a hedge against inflation. So right now we're going through everyone's experiencing an inflationary period. So will home ownership be a hedge against that? So real estate is one of the time-honored inflation hedges. So you're able to lock in your monthly payment, your monthly mortgage payment, instead of having to, opposed to renting, where you are at the mercy of the landlord, and they can raise the rent on that place along with inflation. So it's a tangible asset, and those tend to hold their value as inflation reigns, unlike paper assets. So if you put your money in a savings account, so you're locking in your monthly payment, you buy a home, you're making an investment in a home, that is going to rise along with the inflationary market, as opposed to just putting your money into a savings account, which actually loses money during inflation. So purchasing a house is helping you hedge against inflation in that manner. So we see that this graph, so home ownership, a hedge against inflation. We can see that an asset increases in value over time. So you are going to appreciate the value of your home over time. And historically, it's always been high. Appreciation has always been higher than inflation. We can see that there were a couple in the 80s, right? You have like a 0.1%, where inflation was ahead of appreciation. But 2021, if you purchased a home then, 6.8% inflation, you had an 18% appreciation rate. So you were able to, because of that high inflation, but you still had a higher appreciation rate, you were able to hedge against inflation in that manner during that time. So it's here a quote here from James Royal: "A fixed rate mortgage allows you to maintain the biggest portion of housing expenses at the same payment." Right, so taxes go up and all that stuff, insurance might go up, but your largest amount of housing expenses stays the same because you have a fixed monthly payment. So you can see what the trend is here. Rental prices rise year after year, home values, interest rates, and rents will continue to rise also. But because you're locking in that monthly payment by purchasing a home, you know exactly every month how much you have to pay towards your housing costs. So here's a rent increase greater than inflation most years. So the blue line is the inflation rate, right? Inflation rate is blue line. Rental price appreciation. So rental prices have increased compared to inflation over time. So we can see this gap here of rental price appreciation compared to inflation. So you aren't able to control that as a renter. As a buyer of a home, you are able to, again, fix that monthly payment. But rental price increases. So even if inflation increases, rental price increases will rise above that. Historically, we see that this graph over 1973 to 2020. So it's always been, there are periods where they do cross, but for the most part, increase in rental price has always been above the inflation rate. So here from Natalie Campisi, advisor, homeowners are shielded from mounting rental prices because their cost is fixed regardless of what's happening in the market. So she's a advisory staff at Forbes. Tangible assets like real estate get more value over time, which makes buying a home a good way to spend your money during inflationary times. So it's an asset you can use, right? So you are investing in it, you have appreciation, fixed rental costs, but you're also using it. So it shields you from all the stuff that's rising around you that's associated with renting a home. So because you're able to fix as many costs as you can because you own the home, you're saving yourself money compared to everyone else who is renting and doesn't know when their rental price for their house or apartment is going to increase. And you're gaining money, but you're able to use that asset, which is not compared to like a 401k or investment account where you're investing it, but you're not able to use that money that you are investing, right? When you invest in a home, when you purchase a home, your value of the money that you have invested to purchase it, your appreciation goes up, but you're also able to use the asset while it appreciates in value. So cumulative house appreciation, everyone's afraid that they've bought at the peak of the market and that they're going to in the next few years that they're going to lose money, and people are still afraid of the 2008 housing crisis, how people were upside down after they finished their home. So this is a graph that shows they interviewed some economists, people that study the market, advisors to people who regulate the housing industry, and of all panelists, they say 43% of them said that you will still continue to appreciate value in your home all the way through 2026. And that's just how far out they forecast, right? There are optimists on the panel, 62%, said that you would, continue to appreciate. So average, right? About half of the people, on the board said that you would continue to appreciate the value of your home over time. So that you should not be worried about experiencing a upside down market as we did in 2008. Let's talk about mortgage rates. So they've been on the rise as of late. If you've been watching the news, because of inflation and housing prices, they've started to raise the interest rates here. So this is old data already, right? 217, and that's even old. 3.92% was the 30-year fixed mortgage rate. So you can see that they've been rising since the beginning of last year, but still considering that you're able to appreciate home value, this increase in interest rate shouldn't stop you from investing in your home and your future, and get an asset that you can continue to use while you make money on it. So this graph is 30-year fixed, and we can see here 2022. So this is from 2020 to 2022, and we saw a big dip let's move this down here, a big dip at the beginning of 2021, right? So we were like below 2.7%, and we're all the way here. But like I said, 3.9 was what I saw at the middle of February. We're getting back. We're still below where we were before all the pandemic stuff happened. But this may be a sign that we are returning to more of a normal lending cycle. So, still historically still pretty low, but not as low as it was at the beginning of last year. So here's a wider shot of the interest rates all the way back from 2008. So around September 2018, we were pushing 5% for a 30-year fixed, right? And even if we're above what this data shows is 3.5%. for a 30-year fixed, we're still well below where it was in 2018. So you're still getting a deal on your money that you borrowed compared to a few years ago. It's on the uptick, but if you look at a larger shot, you can see that you're still getting a discount on your money. So here's Sam Cater, chief economist, Freddie Mac. As mortgage rates rise, we do expect some moderation in housing demand, causing house price growth to temper, which means that the rate at which it's rising is going to level off. However, the combination of large number of entry-level home buyers facing a shortage of entry-level inventory of homes for sale should keep the housing market competitive. So we're going to see a slowdown in how fast prices are going up. but we're not going to, take a dive in the other direction. So we should be prepared to, still have to look for a home. If you're selling your home, you're still going to get a competitive price for that home. But we are going to see a little slowdown in how fast these prices are rising, right? Here, current mortgage rates compared to the last 5 decades. So again, this is like 3.9 now, so instead of 3.55. We're still lower than since the 70s, right? We all know what happened in this time period here. It was really expensive to get a home if you were back in the 80s. But you can see historically we're still in pretty good shape comparatively. So this is a graph showing the 10-year Treasury yield. A lot of economists compare or can track mortgage rates compared to this. And we can see since the end of 2021, this is 12/1/2021, we've been on the rise, right? And what does that look like compared to interest rates, right? So this is the relationship between mortgage rates and the 10-year Treasury yield over the last 50 years. And we can see that it tracks pretty close, right? There's a delay because one has to be, following the other. But we can see here, the 10-year Treasury yield, which is the blue line here, is on the uptick. So it shouldn't be any much longer before this starts to rise also. We've seen that already from quoting the interest rate data in these slides compared to what I saw 2 weeks after these slides were created. We're already on the upswing as far as interest rates go. So if you want to try and guess what's going to go on in the interest mortgage market, you might want to be tracking the 10-year Treasury yield as well. So here's Joel Kahn, Associate VP, Economic and Industry Forecasting. Mortgage rates hit their highest level since March 2020, lending to the slowest pace of refinance activity over the last 2 years, right? So we refinanced at the beginning of the pandemic. There were a lot of people that took advantage of the cheaper money. People aren't moving. They're more, they're a lot more comfortable in their home after, they see what's out there in the market. They decide to refinance instead of purchase a new home. So we've seen a lot less people doing that here recently compared to the beginning of the pandemic. So we've all heard of forbearance, what the government was able to do for people who were out of work during, or weren't bringing their money during the start of the pandemic. A lot of people took this as like forgiving the mortgage payments that they owed, which is not what it is. It is delayed the collection of mortgage payments if they were not able to pay their mortgage. But what we can see, and what we'll take a look at in the data here, is a lot of people came out in good standing when they had to start repaying this forbearance. So loans in forbearance fall below 1 million. So we can see that people have been coming out of forbearance. That's not something that you can stay on forever. So we can see that, monthly number of loans in active forbearance in millions. So we are here, actually the data for February and March, well, February is not here yet, but we are well below where we started. And that is, people are coming out of it by doing some action. And we're going to take a look at what that action is here in a second. Andy Walden, VP of Market Research, Black Knight Data. As the COVID pandemic continues to create uncertainty in the global economy, the overwhelming majority, 89% of single-family homeowners who sought financial assistance through COVID-related mortgage payment forbearance plans have exited those plans. So this is not what happened in 2008, where people were walking away from their homes, or it was difficult to get to work out a different terms of your loan. This was putting your loan on pause because you weren't able to pay it. But people are coming out of it, in a positive way. They're not just walking away from their homes. We're actually having companies work with homeowners to have them to keep their homes and keep them in their homes so that the banks will have to collect all these homes. So here's the chart that I was talking about. So loan loans upon exiting forbearance program. What we can see here is that the green chart, so 38% of all the people that were in forbearance, they came out of it paying, either bringing their mortgage current, so made monthly payments during the forbearance period, so they used it as a safety net, but they still made payments. Their loan was paid off because they were already close to paying off their home, or past due payments brought current. So 38% were able to completely exit forbearance, not owing any money, and just bringing everything current. We can see in the blue here is 43.7% either got a modification or loan deferral, where they put the money that they owed, either they modified their loan, so they took the money that they owed and spread it out over the new terms of the loan, or they just added more time onto their loan. So 43% came out that way. So these people, so what is that? 70, almost 80% of the 80 some percent of the people were able just to get their feet, back on the ground, and they brought everything current in some way, right? Either making their balance zero of what they've owed, or negotiating new terms to their loan. 18.2 still in trouble. 16.9% had no plan at all, so they're in forbearance. They don't know what they're going to do. 1.3% short sales, deeds in lieu, repayment plans, right? So what's really helping these people here in the 18.2% is that they still, in the previous slide I showed the amount of appreciation people were gaining in this time period, these people still have equity in their home, right? So they're able to sell it or deed it, right? They're able to get, not have a negative effect on their credit, because they're able to do something with their home, because people want to buy it because of the current market, but they also have equity in their home, so they're not upside down when they decide to get out of their loan, or whatever they're going to do to get out of forbearance, even if they don't have a plan. So these are the number of foreclosures. So this is through Q3 2021. We can see that we are much, and this is 2017 to 19. So this is just recent data, right? The quote unquote normal number of foreclosures, right? So this is where the forbearance plan came into play, right? So yes, these 29,160 people, they were able to not have, these were foreclosures. These people, 261,000, if we just say an average number, if we're estimating what should have been the number of foreclosures that happened in 2021 and 2020, these people in the white outline were helped by the forbearance program, right? These people in red for those 2 years, they lost them just for normal foreclosure proceedings. But we can see, yeah, it's a lot less. Yes, the forbearance helped these people, but this is a lot more people that were able to keep their home when they had financial hardships. And if you go back and compare it with this graph here, they were still in somewhat good standing, right? A large majority of them, compared to when, if you look at this chart back, 2008, 9, 10, right? All these numbers would be, well above this average line. There was no forbearance there, so these would be like everybody that had an issue would be, their data would be collected in this chart. So foreclosure activity is at an all-time low. Again, this is the caveat of forbearance here in 20 and 21, but we can see this area in red, right? From 2007 to 2015, this was the housing crisis. We can see how many people compared to what happened before and after, and also compared to what we would consider to be like an average number of foreclosures that just happened naturally. We can see that we are in much better shape than we were during this time period. And that's really because, when you now get a home, you have to go through lots more vetting. You have to provide a lot more data. They want to make sure you can afford the home. They don't want to just give homes away to whoever wants one like they did here, and not really checking if they can afford the home. Qualifying for a home and affording a home, two completely different things. So this is Mary Claire Bolton Smith, Senior Leader of Research, CoreLogic. We may see a little bit of an uptick in foreclosure rates in 2022, just an uptick though from an extraordinarily low level. We're not expecting to see a big increase. And that's because of that slide that I showed. The people are still in forbearance or trying to work something out to keep themselves current, right? Everybody knows that it wasn't a good thing that, you know, it was necessary because that's the process, but it wasn't a good thing to have all those people, you know, foreclosed on, because then you have all these houses on the market. Banks have to take all these inventory of homes back, right? It's easier because, you know, the banks had this guarantee now to hold off and wait to see what happened and to work with the people so that they don't have to you know, do all that extra work, right? Because it was a lot of work on the bank side. All the money that they lost because of the short sales and you know, foreclosures in that way, right? We know that this may be well, this is the proper way to do it in this situation. So if you have any questions on the data that I presented here, please message me. It's a lot of information, but you know, this is just to help you stay current on what's going on in the real estate market. My name is Andres. This is the Ventura County Real Estate Show. I'm a real estate agent here in Ventura County. So if you want to talk real estate, send me an email or a message. If you're out of Ventura County, I have a form on my website. I'll have it in the description. A referral form. I can, you know, talk to my network of agents that I have across the country and get you hooked up with one of them if you're looking for an agent. Please like and subscribe and share. Thanks a lot. And I'll talk to you guys next time.